We're aligned that it's going to be a tough start to the year, Scott. I'm aligned with my good friend Liz Young that we use the term reactionary a lot in our report that we wrote about the short-termism of investors, the lack of perspective. We have now reared an entire generation of investors that all they know is the Fed comes in, swoops in, and saves the day. And we're moving from QE to QT. We already know all this stuff. But I think the key thing, what keeps us bullish is we don't see earnings going to 200. I think that's too simple. I think that's lazy math, applying a 20% drawdown. I really think that this 210, 220 area is very strong, down from 230 this year. I think cash flow, I know cash flow in my 30-plus years of doing this is the strongest I've ever seen it. I know stability in terms of earnings is the strongest I've ever seen it. So from where we can add value is this. We think the normalization process has begun, meaning high single-digit returns, single-digit earnings, 3 to 4% 10-year Treasury, higher than normal inflation and interest rates, which will cause investors that have not been in the business more than 20 years, they're not going to know what's going on. I think it's kind of back to the 80s. And we are in an active stock picking market, which means that I do think that we're going to see forecasts for 2023, something that we talked about for months now, come down from our companies in the S&P 500 in January, February, which is going to cause some consternation in the market, which is going to cause the weakness. That's your entry point.
Okay, so I would say that, you know, when you accurately mention the fact that there are a whole group, large swath of investors who don't know anything but Fed-induced markets, because that's the way it's been since '08, that's fair. That's fair. But I would counter that by saying, well, then you, of all people, because you always mention your 30-plus years in this business, should know better.
Yep.
You should know the power of the Fed better than most on both sides of the boat. Right?
Correct.
It helps when it helps, and it hurts when it hurts. Weiss, who you say you're in agreement with, knows the hurt that is likely lying ahead, in his view, because of this Fed tightening ongoing into what is still a slowing economy. So that's that for me.
So let me reconcile that. So this year we were wrong. Steve was right in terms of the length and duration of high inflation. We thought it was going to come down a little bit faster, and we thought the Fed, as a result, was going to act. We've always been very respectful to the Fed, and we know historically that the Fed is late. And we actually do think that the Fed's got it right. But we do think that you cannot ignore the reality, and reality bites sometimes. The reality is the yield curve inverted. The reality is that at some point we're going to have a recession. Whether or not it's already happened, I think it's a moot point. The stock market's already told you that. I think the key metric that we have to understand is, going back to 1945, is the actual calendar year where we have a recession, the average return on the stock market's 5.8%. On a positive side. So again, I think the market's already largely discounted that. I agree that we have another downside to the market. It's just a matter of how we want to invest. And I do believe that where the other value add that we can produce is, I think consumer staples and utilities are no longer defensive. People chase those. They're extremely expensive.
Well, they can be defensive, but they can be expensive. They're too expensive, you say, because too many people chase them to play defense.
From a valuation perspective, I've never seen utilities in terms of cash flow, earnings, yield, and price of sales as high as they are right now. Staples, we've seen the largest relative valuation increase in Staples history. Now, from an earnings perspective, the Staples earnings are not as stable as even technology. And so where I think is going to end up happening is the more defensive areas in the market are become healthcare, financials, more traditional value, and some communication services. But I think as the year progresses, we're going to be much more small mid-cap, much more domestic. Assets are coming back to the United States, and I believe that we have a long-term value market coming.